Okay, I think we can get started here. I'd like to welcome everyone to the virtual seminar on monetary economics. My name is Michael Bauer. I'm a senior research advisor at the Federal Reserve Bank of San Francisco. And my co-organizers for this virtual seminar are Refet Gurkaynak, Claudiana Istrefi, and Michael McMahon. So this is a new online seminar series that focuses on research on monetary policy. It's a joint initiative of CEPR and the San Francisco Fed. We're really grateful to CEPR for the logistical and organizational support. Refet, do you want to say a few words on CEPR?
Indeed, this is the CPR's reason of being, to disseminate knowledge and bring people together. And being able to do this online, and in particular with such a distinguished lineup of speakers in the inaugural year, is a pleasure. As Michael said, Michael, Claudiana, and I will be jointly running this, and we're going to take turns in chairing these sessions. Michael Bauer will be chairing this first one. And we're looking forward to having a continuing conversation over many, many seminars with preferably a lot of the people joining again and again and bringing up, what we were talking about this last time, but look what we're seeing here today, whatnot. So the whole point is to have, albeit online, an interactive seminar where people who are not always able to come to CPR conferences are now able to benefit from the expertise of the top people in the field.
Excellent. Thank you, Rafet. So yeah, it'll be a monthly seminar and folks can see the schedule online. We indeed have an excellent lineup of speakers. So the format will be that the speaker will have 40 minutes for the presentation, during which we hope to address a few clarifying questions. But then the bulk of the questions we'll save for a Q&A session, hoping to have 15 to 20 minutes in the end for that. Okay, so it's my great pleasure to introduce our inaugural speaker, Ivan Werning, the Robert M. Solow Professor of Economics at MIT. Ivan was born in Argentina, and he earned his PhD at the University of Chicago in 2002. Among his many accolades, I'll just highlight a few. In 2008, The Economist recognized him as one of the world's top young economists. Then he was elected a Fellow of the Econometric Society and an elected member of the American Academy of Arts and Sciences. Ivan's highly influential work spans the fields of macroeconomics, public economics, and international economics. So today, Ivan will kick off our new seminar series by presenting research on a topic that is indeed very timely and highly relevant for monetary policy, and that is the optimal policy response to tariffs. Ivan, thank you so much for joining us, and the virtual floor is yours.
Thank you. Thank you to all the organizers. And I think this is a wonderful offering, this new webinar series. And it's a pleasure for me to be here today. Let me get this slide deck started. My co-author, Guido Lorenzoni, I think is also joining us. I think Veronica Guerreri is at a conference, so couldn't be here. But yeah, this paper started and we wrote it kind of in a flash. It's a very applied piece of theory work, as you'll see, which is trying to, see what our best monetary models and intuitions have to say about this pressing issue of what the monetary policy response should be to increases in tariffs. Okay. And I think this is an issue that's got some attention, and I think we have something to offer here. I'll try and explain later in a large and growing interesting literature. Okay, so without much ado, tariffs raise many issues. I want to clarify. I've worked on some others, purely trade sort of real issues, and you could even think of what is the effect on deficits and things like that come up from a real perspective. Today, I'm going to focus on the more macro effects, short-run effects, thinking about inflation and demand and supply effects, things like, is this going to lead to stagflation or what the optimal monetary policy response? So for the optimal monetary policy response, I think, we have very interesting models that help guide us. And we're going to try and use that kind of model to get some simple guiding principles. Okay, I think that's where our main contribution is going to come in, to take this issue, which is somewhat complicated. There's kind of a very basic intuition, but sometimes, if you look at the models, they say more complicated things, and it's hard to see through them. And we're going to provide a simpler lens, I think, than what's been available. And that, I think, is what we attempted, and that's what we have to offer. Okay. So to put that in perspective, I do work on open economy models, and I've always felt like, well, I'm from Argentina. You can't do macro and not do open economy, but it is kind of a hard thing for some people, and it is a little always. The reason is obviously compared to a closed economy model, it adds at one more level of difficulty and many more margins and questions. And then often in these models, you end up, when you're looking at optimal policy, having to deal with terms of trade effects. So I say this as context for the kind of decisions we're going to make in our modeling choices. We view this kind of these models as sometimes a little harder to get intuition from. Okay. And these terms of trade effects sometimes are warranted and very important, but sometimes they're a bit distracting from the main issues. So we're going to write a simpler model, simpler open economy model in continuous time, and you'll see there's some benefits of that. But the model is going to be extremely simple, and we're going to provide a very tight equivalence result showing that it's related to a closed economy model with no terms of trade effects. So our main goal is, I want to sort of say, if I have a brand or a style in kind of the work I do in New Keynesian models, it is to try to keep things sort of simple and try and think normatively about optimal policy in a way that you can get some analytical results and get some intuition, and also connect to known results. And that's kind of what we're going to have to offer here. I say this because another approach is to write a more extended, complicated model, which you just then simulate. And I think those kind of other approaches are complementary to ours, but this is kind of going to be what you should expect today. All right. So our main result, I'm not going to go too far into an introduction, just to say what the main result is so you can anticipate, is going to be this equivalence showing that this open economy with a tariff shock is equivalent to a closed economy with a cost push shock. Okay. And the open economy is going to be very simple. There's going to be trade and inputs, and there's not going to be any terms of trade effects. And there's an important simplifying assumption, which is we're going to fix the trade balance. Okay. We're going to set it to 0, but you could set it to another exogenous. So like the capital count is closed. Okay. And we view this as obviously this is where the rabbit enters the hat. It gives us a lot of tractability, and it allows this perfect equivalence. But we think that, if you relax this assumption, you would get very similar things, but it would be harder to see. Okay. So anyway, the main point is that the outcome of this equivalence is you can see then the results of a tariff shock and how the optimal monetary policy should respond, in large part by going back to your well-known results in the closed economy. And I think that makes, again, because it's such an important issue to think about this open economy question, but open economy models are harder, it's very nice to have this as a baseline. Okay, so that is kind of the payoff of this equivalence result, is we're going to get very simple results. And to say the substance of the results are going to be the monetary policy should accommodate and allow a high inflation on a transition, but eventually go back to 0 inflation. Okay, and there's going to be some other more detailed results I'll get into later. Okay, in a 40-minute presentation, I can't go into details on the literature, but I want to, shout out to a bunch of people working on this, and there's probably missing papers here. If I would say one thing here is some people are misinterpreting my paper as sort of saying that Bianchi and Colebale are at odds with our results, and I don't see it that way. I think we take a different perspective, and they took a more, exhaustive search sometimes with the aid of numerics, and we have this more simplified model that has this equivalence that they didn't have. But if you end up looking at our impulse responses and things like that, I think they're largely consistent with each other. Okay, and it goes to saying also that their paper came before ours. So I think we're adding to this literature by making these results, I think, more interpretable and simpler. Okay, that's part of what we do. And then we're also going to get some more mileage, and we'll be able to study things like sticky wages and things like that I think end up being quite important. Okay, so let me show you the model, and I'm going to start with the static real model just to set ideas and tell you what the model looks like. So as a warm-up, let's just think of a single period, and there's going to be a representative consumer in the home country, which has consumption and labor. Okay, so standard macro model. And there's going to be a production function that takes labor and an input, which will take as being imported to produce output. And the output can then be consumed or exported. Okay. Now, this view that what imports are basically an input into production makes sense at an aggregate level. I mean, first of all, you can interpret any import that's like a direct consumption good as requiring some amount of value added at home just from importing and putting it in the retail process. But more generally, I think, so this captures, I think, in a general aggregate way, what we mean, by international trade. Okay, and then to simplify, we're going to think of the economy, and this is a simplifying assumption, but I think helps because we don't think it's necessarily of the issue to consider terms of trade effects. We're going to take the prices of output, imports and exports to be exogenous to the country. So literally speaking, this is like a small open economy, okay, without any terms of trade effects. And to simplify, then we're going to normalize all those prices to 1 in the present discussion until we go later into the monetary model. In the static setting, I'm going to normalize them to 1. So finally, the last condition is that imports have to be equal to exports. So imports are M with a normalized price of 1 with trade balance. Imports are equal to exports in the static model. Okay. All right. So let's look at what consumption is equal to then. Consumption is equal to output minus exports. Okay. Because that's what's left for consumption. But given that exports is equal to imports, it's equal to output minus imports. Okay. So it's convenient to divide by labor because then with constant returns, this frontier for consumption can be easily seen to be linear. So I'm denoting by mu the ratio of M, the input to labor. Okay. And this is a condition that goes quickly to the point. It might seem mysterious. I want to talk about wages now. So for any tariff tau, I'm going to introduce a tariff now. The wage is going to solve this equation here. Effectively, if you didn't have the tariff, the wage would be, there would be no profits left over, okay, to the firm. And so in a constant returns to scale economy, the profit margin is going to give you the wage, okay? And this is the analog of that once you introduce the tariff, okay? But that immediately implies that if the tariff goes up, the wage is going to go down because the wage is earning what would have been profits, okay? So when the tariff goes up, you're paying for something more expensive, the inputs, and so the wage is going to fall. So this W is decreasing in tau, okay? And it's this maximization of mu, which is the wrong one, because the economy as a whole does not really have an extra cost tau of importing. It should be a tau equal to 0 there when you're maximizing. But the inefficient choice of imports, the well-known point that tariffs create some inefficiencies in import choices, is captured here by that tau, okay? Perhaps another way to see it more familiarly is the first order condition is going to be the marginal product of inputs is equal to 1 plus tau, and it should be 1, not 1 plus tau. And so that's going to give you what the import over labor ratio is as a function of the tariff, okay? And it's going to be naturally then decreasing. If you raise tau, you're going to have less imports over labor. You're going to try and save away from imports. Okay, so that's capturing the usual substitution effect. And then to close this static model, let's think about the optimal labor supply, the optimum of the household. They are going to have this first order condition using the wage, okay? Importantly, they're going to be using the wage to determine their labor. So the root of all distortions here is the tariff, okay? But it's kind of impacting two things. It's impacting productivity here in the sense of the ratio that you can get for consumption for any given labor. This is going to be a linear relationship between consumption and labor. I'll show you the plot in a minute. And that's getting affected by the mu. And since the tariff is affecting mu, it's affecting this productivity, so to speak. So that's capturing the idea that if you raise tariffs, the economy will be less productive, and you will suffer that productivity loss. But the other inefficiency shows up in this wage, and that affects this labor choice, okay? So kind of interesting, but I don't want to make too much of a point of this, is that if you just think of in these terms, the productivity effect is actually always there, but it's first order zero, starting at a zero tariff, okay? This is kind of a well-known idea that when you start undistorted and you introduce the first distortion, it has a very small effect, technically zero to a first order, okay? Whereas the wage drop is first order, okay? So that's going to have some implications, and that's why the main thing I want to flag here is if you thought intuitively, yeah, tariffs create a productivity loss, and then you don't think of the labor wedge, it's kind of the reverse. Like if you think of it this way, starting from a zero tariff, it's the labor wedge that's first order, and the other one that's first order zero, okay? You'll see that for welfare, they're kind of more on equal footing. I'll say that later, but I just want to kind of upset maybe your priors and make you think about this labor wedge, okay? So there's basically these two distortions, but only the labor wedge is first order. Let me see this on a graph. So here's the consumption labor frontier in the static model. And if you were doing the first best, you'd be at this optimum, okay? But because you introduce the tariff, you get this productivity loss, okay? And that's bad. That's the inefficiency number one, okay? But then the other inefficiency is that the wage is even lower than that productivity, okay? All right? And that's the second loss, and that's the labor wedge, okay? So you're going to go to a distorted place even on the green line, okay? Now, what you can't see here in this figure is that really the first order versus second order question, because we're drawing it for a big discrete change, okay? All right, so I'll come back to that figure in a minute, but if you look at welfare losses, I said they're more on equal footing. You can express the first order loss is zero as usual, but we're always going to work with second order then. And the second order losses are non-zero, and they're, the tariff hurts this economy in general. So then what is it? You can show that the welfare loss is coming from exactly these two inefficiencies. And this is what these expressions are saying here. And intuitively, they both represent like Harberger triangles, one for imports and the other for the labor supply choice. That'll kind of have a parallels in the monetary economy. You see the quadratic welfare function. So that's why I wanted to flag it. And I also want to flag ahead of getting into the full model, which I'm going to do momentarily. What is monetary policy going to do? Just at an intuitive level, monetary policy is going to start from that distorted outcome down there, and it's going to be able to do it's good, in the simplest setting, it's going to be able to attain that if you want to, but it's also going to be able to attain other things by virtue of controlling monetary policy and the fact that there are nominal rigidities. In particular, it can expand labor, and so it can move to the red dot there, okay? And it can also get in between the green and the blue line, okay? So those are the interesting things monetary policy can do in the short run and in the long run. But of course, these have trade-offs with inflation that we're going to have to model now. So let me jump into this dynamic model. And it's going to be a simple extension of what I just talked about. So we have now a discounted version of the same utility. And each period, we have the same production function, okay? Constant returns. Again, we have the same normalization of prices. Again, we're going to impose, for simplicity, the closed capital account assumption that the trade balance is holding. It could be a trade imbalance, but the important thing is we don't want to endogenize that. We want to keep it simple, okay? All right, so Now to add nominal rigidities, we do the usual thing. We sprinkle a little monopolistic competition. Each good really, there's a variety produced by monopolistically competitive firms, and they have a Calvo resetting price nominal rigidity. Okay. So without going into those details, this is all familiar. That's going to give you that the prices can't just jump. Okay. And they have a transition. An important difference when you have nominal rigidities, and I kind of highlighted that by showing that red point, is you don't have to live on the green line. The reason is now the wage isn't the real wage is endogenous. Okay, so monetary policy can expand the economy, and that can affect where the real wage ends up. And that's different than before when I assumed that firms had to be on their ISO cost, earning zero profits, and that implied that I could just back out the wage from technology. But that's no longer the case when firms find themselves with some nominal rigidities in prices and they have to meet demand. Okay, of course they might want to meet demand because they have a markup, but the main point is you're not traveling along an ISO cost curve where if the wage goes up, where if the tariff goes up, the wage has to go down anymore. Okay. All right. So I'm going to explore both flexible wages and sticky wages. Let's start with flexible wages. So here's the exercise, pretty standard. Start at a steady state with zero tariff, and we have zero inflation. We know that's optimal there, and we're at the first best. And we have an unexpected shock that suddenly we raise tariffs. The home country raises its own tariffs. Okay? And then we're going to solve for the perfect four-state equilibrium from then on. And to simplify, sometimes just imagine the shock is permanent, but everything we do, extends to the tariff might have some path, okay? But we don't deal with uncertainty, which I think is an important issue, of course, in present day when it comes to applying and thinking about the exact timing and impact of things. We simplify away from uncertainty. Okay, so here's our main result. Let me just state it. And then I'm going to backtrack and try and explain it. The main result is that the economy is equivalent to a closed economy with a Phillips curve that's described by this differential equation. This differential equation in continuous time might look a little different from what you're used to in discrete time, but it's the basic Phillips curve. And the important thing is you have kappa times y, so that's how output, now a higher output creates more inflation. And you have this epsilon that's like a cost push. And the cost push here we show is proportional to the tariff, okay? So in particular, in the case where we do a permanent tariff, then you just get a permanently higher epsilon. You start with epsilon 0, you get a permanently higher epsilon. And that's going to imply that you're going to get inflation if you don't make y negative, okay? Because if y stays at 0 and epsilon becomes positive, the solution to this differential equation is you're going to get inflation, okay? All right. And then the second part of this result is that the welfare function also looks exactly like the textbook. You open Woodford or Gali or many other textbooks, boom, here's the quadratic welfare function we all know and love. That features output and inflation, okay? And in particular, importantly, the shock is not inducing any change in what would be the target or efficient level of output. Okay, so I put a big fat 0 there, all right? So to sum up and write it as a proposition, like this is the result saying, we show that the open economy plus a tariff can be studied by the closed economy with a cost push, okay? So now it's time to, unpack this and see its implications. So let me start with some quick implications. And the beauty is now really, you just have to go back and think of what cost push shocks do in closed economies. And we sort of know these results. And we can just reinterpret them in terms of a tariff. So we know that with the cost push shock, the optimal response entails a gradual adjustment of output to the lower level, okay, to eventually not have inflation, okay? Let me make one caveat. It's common to study cost push shocks that are transitory. That makes sense. In our baseline, this is like a cost push shock, except it's permanent, okay? So when you apply the known results to that, what you get is the following: that output starts at 0 And this we prove with continuous time. We can actually show it's exactly at the position it would be at 0. There's no impact effect, and you wouldn't see this in discrete time. And then it falls gradually to its new level, which is the level that avoids having inflation. And inflation instead rises then, and then eventually goes down to 0. Okay. So I'll come back to this because this is sort of textbook, and I'll insist on that. But I think this is the power of this equivalence result. A little surprising result in the background, now I switched figures here, is I'm showing you employment. Employment actually goes into a boom here. We'll see that this is less robust. This depends on the economy with flexible wages. I'm going to show you one with sticky wages in a moment. Okay. But I think one important question that's more robust is why are you doing this gradual adjustment? And why then, if you do want to fight this and have a higher output and accept inflation, why do you only do that temporarily, but in the long run go back to 0? To emphasize that this is not a case where the shock is temporary, which in that case, it's obvious you should go back to 0. Okay. So it's kind of interesting that the tariff is permanent and you have this kind of transitory response, which perhaps is intuitive, but I want to emphasize it's not like direct that, okay, you put in a temporary shock and hence you go back as the natural thing. All right, so let me unpack this a little to provide kind of a sketch of the proof and give you then more intuition. So where did this result come from? The basic idea is the let's think of the nominal marginal costs and log deviations. That's going to depend on what happens to the nominal wage and what happens to the price of your imports. And the price of the imports is this, PM plus tau. Now, PM, we said we're going to set equal to P, okay? There's no terms of trade effects. So after you incorporate that and you do a little math, you can show that the inflationary pressure depends on what happened to this marginal cost relative to the price. So that's what's actually in this expression here, okay? And you see that what that depends on is very intuitive. What matters, if you have an inflationary pressure, this is the Phillips curve, we're asking when is this positive, is if the real wage went up and if the tariff went up. Both would provide a pressure to increase inflation. Now, if the tariff goes up, this term is positive. So how can you get 0 inflation? Well, this equation is saying very intuitively, you can only get 0 inflation if the real wage falls. Okay. So we like to interpret that sometimes with a more general setup. I'm just flagging that, but you need a drop in the real wage to prevent inflation. That's another perspective before we go to output. So now we're going to output and consumption. There's 2 log linearized equations that are key. One is a little confusing the first time you see it, but consumption to a log first order approximation is the same as labor, okay? It's proportional to labor and log deviations. Is equal to labor and log deviations. You might say, how can that be? You had this production function with 2 inputs. Yeah, this is not gross output. This is consumption, okay? So this is actually a restatement of the idea that to first order, there was no efficiency loss, if you recall. Because this is then saying that even though you introduce the tariff, it doesn't matter what happened to imports. That's why imports are not appearing here, okay? So it's kind of one has to grapple with that for a second, because I think the first time at least I saw this was a little surprising, but some people have worked with this before. But C equals L, okay? But Y is not equal to L. Y does have this effect of what's happening to the inputs. And that is affected by tau and also by the real wage, okay? And intermediate by this elasticity of substitution. And then the other equilibrium condition that's very intuitive is just the labor supply condition. Under log utility, we get a unit parameter here, but we can do non-log. Just for simplicity, I'm doing log now. And you get the Frisch elasticity, inverse Frisch, and that's equal to the real wage. So these are the equilibrium conditions you have to connect quantities and prices. And when you put that all together, you get that Phillips curve that I showed you earlier, okay? Because intuitively, a higher real activity in Y, in output, leads to higher wage demands through the labor supply condition, which then creates this inflationary pressure. So you get the usual thing. And then the tariff was appearing independently. So that explains the cost push part. So basically, I tried to decompose this and show you why we got those equations, okay? All right, so now let me do the same for the welfare function, just a little briefly. if you start like from ground zero with a welfare function, maybe you would start here. There are kind of three distortions. The first distortion is the productivity efficiency that has to do with what happened to the labor, to the input labor ratio. And the second has to do with the labor wedge, which affects what happens to the labor here. Okay. Under balanced growth preferences, labor would be constant with productivity shifts, but so only the wedge affects labor. And then there's the usual term that comes from inflation, costly inflation in this model due to dispersion, but more generally, we might just dislike inflation, we would add it in an analog way, but we have these three terms, okay? What's surprising, and I'm just stating the next step, is you start with these three terms, but when you use the equilibrium conditions and you plug in and you do a little bit of, expanding these quadratics, you end up with just two terms. You end up with the output gap and the inflation. So that's what's kind of nice. And then you end up with other terms that are independent and don't matter for the problem, but just concentrating on the ones that matter. That's why you get the result we got. Okay. And that result is much more general, I think, in this kind of setting. Okay, so what do we get out of this again? Now, with this intuition, let me go back and give you an intuition for the main result again. So again, the main result is you get the shock. We want to keep output higher than it would be at the flexible price allocation. We could obtain the flexible price allocation in the simple economy, and that would prevent inflation. But we want to transition slowly to this new lower level. So we are sort of accommodating to not have a discrete jump down in output, okay? Moreover, I told you earlier, this employment even goes up, and that's a little surprising or mysterious, but now I think we have an intuition for it, which is that helps because it pushes the real wage up. So I had this figure here where both employment and real wage rose initially, even though in the long run they're lower. But why did that happen initially? Well, because that's helping you fight the productivity inefficiency, because the tariff went up, so firms would move away from imports towards labor to produce in their cost minimization problem. But if you can keep the real wage up, then they'll abstain from that substitution, and that's somewhat good. Okay. All right. So as you'll see, that'll be harder once you have nominal wage rigidity, which I'm going to turn to next. Okay. But first, let me address the key thing I think is here. Very robust, going to come out with wage rigidity too. Why are you not doing this forever? So you want to, this is kind of like you have this menu, you want to go halfway, you want to expand the economy a little and accept inflation, but you only do it in the transition. And I'm going to use this equivalence to give you an intuition by just saying, hey, go back and set your closed economy intuition. But basically, the permanent tariff, remember, is equal to a permanent cost push shock, which, if it's permanent, is equivalent to just having an inefficient steady state. So you go to your favorite textbook and you look at what happens for optimal monetary policy when the steady state is inefficient. And what you find there is first maybe a discussion of the case with discretion, then you get this inflationary bias. But if you look at the actual optimal policy, that is with commitment, it entails transitorily having inflationary bias, but eventually not. And that's what's explaining what we're finding here. Okay, so that's what we like. It's, the tariff really looks like a cost push. If the cost push is permanent, it really looks like these steady states we're kind of used to thinking about. And we know that in the long run, you're not going to have inflation, even though you have this inefficient steady state. Okay, and there's a usual kind of assumption here of looking at a small first order shock. Okay? All right, so that's a standard result, and that explains this limit. Okay. Now, again, if this shock had been transitory, it's obvious. So I'm trying to emphasize that the shock is permanent, and it's not so obvious then immediate, but then when you see it in this way, it's more obvious. Okay, and that's where we think these kind of results are very useful and might open the door to more people understanding how to think of open economy monetary optimal policy. So let me add sticky wages now, and it's kind of important, I think, because some of the results we got, because we're able to get very clean results, show this thing about employment And we want to, think about a more realistic model on one margin then, which is let's put this sticky wages. That's going to create, like we already had a departure from divine coincidence. This is going to create an even stronger departure because you can't even get the fully flexible allocation, and you can't even, or the other side of the coin is also true. You cannot get away from distortions from inflation or deflation because you're going to have some adjustment in prices, and they're always costly. So you're kind of thrown into the second best, third best, no matter what. The key thing to realize is the real wage now can't jump. It's a state variable that moves slowly, okay? Sticky. Price inflation equation is the same as before, so nothing to be learned there, but the real wage now is sticky. So that implies you can't like manipulate the real wage to get what you want, okay? And that's going to create a higher pressure for inflation initially. I think this is a realistic thing. I think studying this question without nominal wage rigidity is always very limiting because when we get the tariff shock, to write down a model where, yeah, we could just have a huge drop in the real wage immediately and avoid price inflation is completely unrealistic. This model is a step in that direction, okay? All right. And the implication is for optimal policy is also we're going to have less attempts to manipulate the real wage and things like that to undo those inefficiencies we talked about, okay? Because both those wedges that I talked about now are going to depend on the real wage, and that one can only move slowly. So let me show you what we get. And then I'll show you the formal result. First, let me show you non-optimal policies to set the stage. So suppose you did mimic what happened with employment. So you drop employment to its new level. Then the real wage would slowly fall because it's sticky. I said that. So you see now the stickiness of the real wage. And you get both inflation in prices and some deflation in wages. So they're kind of both moving to lower the real wage. Okay. And output is almost flat, okay? But it's not perfectly flat because you don't perfectly mimic the flexible price allocation. You only can mimic the employment one. You could also mimic the consumption or output one, and then the other ones would also be slightly out of whack. Okay, now let me show you another optimum. Suppose you say, I don't like that one. I want lower inflation. Well, then you can do it, but you have to accept a drop in employment, a very strong one in the short run, and a stronger drop in output. Okay. And this is going to help the real wage fall much more quickly. Okay. And now what you get is lower inflation and higher deflation in wages. Okay. Which perhaps is pushing the realism of this model that doesn't have, let's say, downward wage rigidity. Okay. But it does have a shorthand version of that, which is it's not easy for the wage to fall here. It's sticky. Okay, so here's the main result that is like analytical again and very, very clean and says, look, with the optimal policy with sticky wages has a transition where inflation is on average positive, but eventually inflation goes to zero. Employment has no effect on impact. This is kind of surprising. Again, these are the kind of things you only get if you do continuous time, because otherwise in discrete time, you always have a little bit of aggregation over time if you want to think of it that way. And then output now does drop initially, but then further declines. So these are a bit different from the flexible wage case, but there are similarities. The main similarity is the point about inflation and the fact that you accommodate and that you don't let output drop all the way immediately, okay? The wage path is more ambiguous and we can get different things. So let me just show you some simulations here that illustrate these results. So now you see the employment doesn't jump up anymore. It's zero on impact. Now, depending on parameters, it could still rise first and then fall. But with these parameters, it's just always declining. And then the output one, take a look at that. It illustrates the point that output falls on impact now, unlike before, and then declines further. So you're still smoothing that out, but less than before. And I think an intuition here is you're kind of in a bind in a bigger way now with the nominal price and wage rigidities, okay? So you can't like overstimulate the economy and affect the real wage as before, and that pushes you to not want to do as much of that as you did before. On the other hand, though, the nominal wage rigidity, I said, that doesn't mean we have less price inflation because the nominal wage rigidity, plus the fact that you may want to not let employment fall too fast means wages might even be rising. And in this simulation, I said that depends, but in this simulation, wages are even increasing over time, which is a little bit of a wage price spiral, if you like. Okay. So here you are getting quite some inflation in the transition, obviously zero again in the long run. And you're getting this drop in the real wage by the fact that wage inflation doesn't keep up with price inflation. Okay, but it illustrates all the points I showed you earlier. Just to contrast the flexible wage, sticky wage, there's a lot in common in the sense that in both cases, you smooth out the drop in output and employment. There's these differences as what happens on impact with employment and output. But in both cases on the transition, you have inflation. There's more nuance in the sticky wage case, what's happening with wages and things like that. In orange, the new curve, but a lot of similarities in these interesting differences. So look at all the, I think, traction we got from our simple model. And I think now I maybe have 2 more minutes, I think, because I think we started after the introduction, past 2 or 3. So I'll try and insert some final remarks that discuss some things I left in the background. Okay. So first of all, what's going on with interest rates here? And what's going on with the exchange rate? I kind of put that in the background, but I'm going to bring it out now for you. And the main point is, obviously, since you're stimulating, you're going to need lower real interest rates. Okay. So now, of course, that doesn't imply lower nominal rates since you are getting a bout of higher inflation temporarily. So whether nominal rates go up or down depends, but you do accommodate in the sense of lowering real interest rates. Now, what's happening with the exchange rate? Well, that was in the background, but I'm not going to get into details now, but you can uncover it. There's kind of a simple way is think that this was a simple model with purchasing power parity, in which case the exchange rate is doing whatever the price level is doing. Okay. And we saw that the price was going up. There was inflation. So that immediately implies the nominal exchange rate. I'm sorry, is there a question?
No.
Okay, sorry. Yeah,
Yeah,
I thought
there
it
is a
was an
question, but
automatic.
when you're done. So go ahead.
Okay, yeah, I'm about to be. Yeah. So what we find, I just want to highlight 2 or 3 surprising things, but I'm going to make it short, is that the exchange rate actually, well, it can't jump here, but it slowly depreciates. Okay. This is a place where we know our assumption of no capital count would affect that because, in general, we have like Dornbusch ideas that exchange rates are a forward-looking thing and you have to think about all that, all right? At the same time, those models are like an extreme and we've moved away from the perfect capital mobility and we're like studying the opposite case. But the interesting thing, I think, more to highlight is what the exchange rate ends up depreciating, not appreciating, which is sometimes what people think a tariff would do, okay? All right, so let me finish with 2 small comments and keep them short. We also in the paper discuss whether this higher inflation is just an instance of what people call the see-through principle. And we show that it's not, that it's more complicated or delicate than that. In particular, what we do is, I do think the see-through principle might be the way central banks explain or justify that they're going to have people should expect a little bit higher inflation. But what we show is not technically just that, because that's a very partial equilibrium view. What we do is we compare what the total inflation was to what would have been if you just did kind of the see-through impact of nominal marginal cost. And we show it can go either way, but that in the case of sticky wages, it typically you get more inflation than the see-through principle. Okay, because the idea is there's kind of a wage price spiral there. So in the end, you're going to see more of that. All right. Briefly, I may say that we studied the economy here with commitment. So you might ask, how much role is commitment playing? And I would say it's playing a pretty standard role. We're not doing like a forward guidance type use of commitment here. It's pretty standard because exactly our equivalent says this is like an economy that we studied many times before where you have an inefficient steady state. And there we were a bit comfortable saying, look, with commitment, we're going to be able to overcome that inflationary bias. And that's the kind of commitment we also need here. So it's not like a new wacky or maybe untested form of commitment. Okay. However, you might say, oh, but from a timeless perspective, I remember some people don't like this idea that the efficient steady state, what you do is this transition. Some people say, don't, just tell me the long run effect. And, Woodford has this idea of timeless perspective that sort of tries to justify that kind of simple-minded idea of just tell me what I should do in the long run. What we thought of, just to mention it, is like, oh, does that mean that everything we did would get nullified by the timeless perspective? Like if you apply the timeless perspective to a tariff shock, you shouldn't really be reacting to it, since it is equivalent to an inefficient steady state, okay? So we actually formally looked at this, and it turns out that, yes, it is ex post, but ex ante, it's not. And because of that, if you model it like a Poisson rate that was coming, a very small chance of a tariff rise, and then it happened kind of like an MIT shock, it turns out, even from a timeless perspective, you do want to react in the way we actually exactly showed you, all right? So let me conclude, because I think I'm right on time, or over time a minute, sorry. But we studied this simple open economy model. And as usual, I think like economic theory is useful when you make assumptions that help you see through the fog and see some simple logic that we think is the most important parts. And then we can complicate from there. I think that's kind of the goal. That's the spirit of this paper. So we study a very simple model. Obviously, it comes with strong assumptions. You may want to relax later, but we think the cost benefit was good, very good, excellent. Sorry. That we can discuss. And the main result then is this equivalence result. It's a powerful way to get results, a powerful way to get intuition, powerful way for all you great macroeconomists that don't do open economy to be able to look at an open economy question. And the result, substantively, bottom line, is that implies that we do want to accommodate the shock in transition, have higher inflation, but that's not the see-through principle. And then we have many other results. I'm not going to keep summarize further, but of course, many extensions, of course, will break this exact equivalence. But we believe that having this exact equivalence helps you understand that probably in those extended models where you don't get the exact equivalence, this force is there. And that's why we think it's important to sometimes write simple toy models that are an intuition pump. And that's what we've done here. Thank you.
Thank you so much, Ivan. So we'll move to the Q&A session, and I'd ask people to raise their virtual hand or put the questions in the chat or Q&A tool. But before we go to the first question, there's one clarifying question that I was also wondering about in the Q&A, and that is, in the canonical three equation New Keynesian model, you get a cost push shock, and then that raises inflation, and you raise the interest rate, and usually the Taylor principle holds. And here, is it true that you actually decrease the interest rate? And if so, why? That was the question.
Yeah, thank you. No, first of all, there's sort of important two differences. Like we're saying it's a cost push shock in a very general way, but the typical cost push shock is done in a temporary setup. That makes it much more easily that you get the nominal rate doing what you just said, okay? Otherwise, in general, the nominal rate is ambiguous, as I said earlier. And what you have that's not ambiguous is the real rate, okay? All right, this is a common thing when you look at shocks, whether they're permanent. Sometimes you have like a threshold per minute row parameter for which the nominal rate goes up or down, okay? So, but that's a caveat here. So you are accommodating in the sense that given what's happening to inflation, what's happening to the real rate, the nominal rate, it depends in all cases. So no, I don't think it's at odds or any way different. You just have to be careful on how you're interpreting that you're looking at real rates versus nominal rates, and that this is a permanent shock, and maybe we're used to thinking of the very temporary shocks.
All right, got it. Thank you. Rafet, why don't you go ahead?
Ron, thank you for this. That's a great start to this seminar series. I appreciated the focus on monetary policy, which is the focus on the series, but have a fiscal policy question nonetheless, which is, if you and I were modeling this at the get-go, with not with this in mind, we have a world, we want to study monetary policy, but there is a distortion that affects the steady state. The first thing would be to devise a tax and subsidy system that would make the steady state efficient. right? That's the new Keynesian way of doing things. Now, there we would say, okay, impose a lump sum non-distortionary tax and then, do subsidies so that the steady state is efficient. Here, we already have the tax. The tariff brings in the tax revenue, right? And of course, in this framework, the ideal thing would be to have the subsidy to offset the tariff exactly. But imagine you can't do this. The question here is, given that the first order problem is with the labor market, can you use the tariff revenues as a subsidy in the labor market to offset that so that your steady state isn't as screwed up and monetary policy isn't as burdened?
That's an interesting question. I haven't, we've stayed away from that in part because, I often do optimal taxes and it's another side of me. So I'm very in with the idea. In this paper, we really took kind of a normative perspective on the monetary policy alone, taking the fiscal part a little bit as given. But I think that's an interesting idea. I'd have to think about it. I still think that we would get these results. But let me think about that harder. What would happen in a full optimum? Of course, if you go to the full optimum, you wouldn't have the tariff shock
Yeah,
in
obviously.
in
No,
the
but
simplest models, at least.
just
So we always have to depart a little from the optimum on the fiscal side, and
yeah.
we've gone to the extreme of
I'm not going
departing.
to push you on
All
this,
right.
but my thinking really is, imagine that some economist who doesn't, some politician who doesn't really get this, insists on this tariff. You are a more enlightened, say, Secretary of Treasury. Can you use the windfall tariff income to offset some of the, or how best would you use that? Now that I
Yeah,
understand that the real problem arises from the labor market. Yeah.
yeah. I'm going to think about that. I
Can
still
I?
think many of these results will go through. Let me just say that yeah, that interestingly, not to politicize this, but at all, but we take kind of as given these things. Um, I guess monetary policies coming out to be the desired monetary policy is more accommodative, um, which maybe seems to be what the current U.S. administration, publicly asks for. So there's, something that some connection I'm also seeing since you're pushing me on that. Yeah, sorry, who's next, Michael?
Sorry, can I add something?
Oh, Guido, please do.
Sorry. I thought I wanted to follow up on Rafet's question if I have a second. Because there is one thing that we did think about at some point, which is suppose that you take the revenue from tariff and you use it to lower labor income taxes, basically. Right? And you can think, okay, we're going to do a tax cut, a labor income tax cut, and at the same time a tariff. But there, the problem is that we know that there is a public finance theorem that says that taxing intermediate is always less efficient than taxing labor income. So actually, the net effect is still distortionary.
Yeah, thanks, Guido. I
And
mean,
so
it's crazy because I was trying to hide my public finance side and you brought
no,
it out.
exactly. I'm trying to bring out the
Yeah,
Dianellis
exactly. Yeah,
Ivan.
we have this result in a particular way, and we think it's more general that once you have the tariff, as long as it throws you into a second best tax world, all these results are kind of robust. And that's kind of what I was hinting at. Because you're still not at the first, you're still kind of distorting labor because I think what people get confused is when you put the subsidy on labor, you're not distorting labor. No, because you still have, people don't work just to earn certain amount of dollars. They earn to see what they can buy with those dollars, and the tariff affects that. So it's well known in public finance that there's still going to be a distortion. Yeah, Michael?
Great. Why don't we move to the next question, Mike?
Yeah, I enjoyed it a lot. Let me just ask. So you talked a little bit about the see-through being different, and I like that. This sort of, as I understood it, this is a monetary policy stimulus to deal with the productivity distortion in the labor market. But you did have commitment, and you did have perfect foresight shock. So if I was a central bank in reality, I guess if I had any kind of questionable reputation or credibility, or if I thought about expectations as being formed potentially in a non-linear fashion, I guess that would take away quite a bit away from the extent to which you want to stimulate, because in your world, your participants form perfect rational expectations of the inflation, and you get the nice effects. But I guess if we had it that they might sort of lock in these higher inflation for a period, it would reduce the attractiveness of this temporary policy.
Yes, that's true for any of the in other words, that's a blanket statement of all results that point to deviating from perfect price stability. But I don't think it's particular to the tariff. So you could say, I always apply a factor of 0.8 or 0.7 to result, because I think there's some added benefit of price stability you're missing. I think you would apply it here. I don't see a particular reason why you would add it to tariffs in any addition. But yes, you could have some of that, but I'm not sure it always plays out that way. But yeah, that's it's true that we do the baseline with rational expectation. I'm fully on board looking at other things I've done in the past, but this is a one step at a time analysis, and we didn't do that here. But yeah, no, I like the idea. But I think the commitment would go the other way somewhat. Like if you don't have commitment and you are discretionary, well, okay, this could create a lot more inflation because what you're saying is, okay, but now you have a reputation to manage that is non-rational. In fact, we're looking, so that's going to temper me somewhat. Okay, but then I don't know if I'm still having more inflation or less inflation than the baseline I showed you. It's
I'll
not
tell you.
necessarily going to be over hawkish just because people are, it depends how you write the model.
Yeah, I guess my prior was you'd go towards more hawkishness if you sort of worried
Yeah,
about
I don't have
higher
that prior,
inflation.
but if you have some general result of that nature, I'm super interested. I have a student working on some related things that have helped me understand, and I still don't understand those issues fully. But I think the general intuition is what you think, but I'm not sure it's always the case that you just are overly hawkish. But that's an interesting point.
Okay, so we've got a few more questions in the pipeline. So we'll go to Carlos. If you can ask your question, please go ahead.
Hi, Carlos.
Okay, I guess Carlos lowered his hand. So then we've got another question. If you could talk about the terms of trade assumption, what do you have? Can you say that? What could happen if you don't abstract away from terms of trade effects in response to a higher tariffs, and how that could change the policy implications?
Yeah. That's something on our list. My intuition, so I'm going to go on, first of all, when you add terms of trade, it changes whether the tariff was a good idea or not. So if you have a lot of terms of trade, it could be you like putting in the tariff. That's a standard trade thing. More subtle is how does it affect this monetary policy response? And my intuition is it could affect it if you think monetary policy is going to play a big role in affecting in shaping those terms of trade effects, which is often what the models with terms of trade effect kind of end up forcing you to do. Okay. Now I think of that as a little bit of a mixed bag, because do we really think the Fed is thinking about the terms of trade effects? And it's a question I think one should ask. I think not clear. So overall, I'm not sure what it would do. I think there's a less subtle point about terms of trade, but then there's a more subtle point for monetary policy. And I think it wouldn't affect the results. Obviously, for sure there's continuity here. If you had a little terms of trade, this won't go away. But I don't see an intuition why it reverses things or anything like that. And if anything, I would defend not having terms of trade effect for this question. I think sometimes it complicates the analysis and makes it somewhat more difficult to follow and more questionable what the conclusions are.
Excellent. So I think we'll have the last question now by Anton Narkov, please.
Hi, thanks for the interesting presentation. Is the effect symmetric? So would a permanent decrease in the tariff require transitory deflation?
Yes, in our model, everything is super symmetric, so you would get that. It's a linearized quadratic, so you would immediately get that. So you could then go back and try and model some asymmetry or something if those results would go, in a direction. I think I kind of hinted at that when the solution was asking for wage decreases. So I'm open to that. Especially like you write down the model, it's extremely simplified. You didn't put asymmetries, but then you got something that doesn't really test it. Then you maybe it's a pass. But if you do get something that really goes against some asymmetry you believe, then you really want to think harder. And you're pointing out that in the reverse case, you might have this deflationary, and it would be deflation in prices and wages likely. And that could again test, for all the reasons we think deflation might be more costly than inflation, or more difficult or more sticky, especially in the case of wages. So yeah, that's how I would think of it. But the model as it is completely symmetric.
Excellent. Few more questions in the chat and QA we didn't have time to get to. My apologies for that. But Ivan, thank you so much for a really great presentation. I also want to thank my fellow organizers and the panelists here today, and to everyone for joining us today. So the recording, as well as the slides, if Ivan's okay with that, which I assume will be available on our website. And the next virtual seminar on monetary economics will be on October 9th, when Ricardo Reis will present his paper, The Anatomy of a Peg, Lessons from China's Parallel Currency. So we hope that you can join us again then. Thank you so much. And this concludes today's seminar.
Thank you so much. And I just want to add, because questions were left, if anyone wants to email me the questions they didn't get to ask, happy to try and answer those. Thanks. Bye.
Thank you, Ivan.